Today, markets are awaiting the release of a closely watched October labor market report in the United States. Positive employment results are likely to become a signal to the Federal Reserve to consider the possibility of interest rate hikes. Consequently, it could lead to a stronger US dollar. By the rumor sell the fact, this old investment credo still works today. Ahead of the US employment report, the greenback is steady around its highs. So far, traders are waiting the data, but at the moment the report is published, the market may well enter a downward correction. This way, traders will be looking in profits on their earlier trades. Let's switch to the H4 chart. As we can see, the euro-dollar pair is trying to consolidate below the support level of 1.1550. As soon as it falls below 1.1535, the quote may well go to 1.1512. Given that the price could rebound on strong employment data in the United States, the bullish trend is likely to resume after consolidation above the resistance level of 1.1564 with a target at 1.1604. Anyway, the upward movement is not expected to last long. Investors should remember about the dovish ECB. The European regulator is still not ready to change the course of its monetary policy, even despite the fact that inflation is at its 13-year high. President Christine Lagarde has recently confirmed that the ECB is unlikely to increase interest rates next year because medium-term inflation expectations remain subdued. Indeed, the Eurozone economy is not ready for drastic changes in monetary policy and still needs stimulus. And today's macroeconomic statistics confirmed that. Industrial production in Germany, a locomotive for the region's economy, declined by 1.1% month-on-month in September. Meanwhile, economists expected industrial production to grow. Meanwhile, in the Eurozone, disappointing retail sales data came out. Industrial output unexpectedly dropped by 0.3% in September, despite market expectations of a further increase. And it seems that it's time for the ECB to finally take action as prices are growing and sales are decreasing. As for the GBP-USD chart, we can see a clear bearish trend. The pair is now surely oversold. At the moment of preparing material for this review, the price approached the support level of 1.3435. The difference in the Fed's and the Bank of England's rhetoric is now widening of the pair. Yesterday, the Bank of England announced it would keep interest rates unchanged. At the same time, the regulator said it might well raise rates in the upcoming months so that to return inflation to its 2% target. It could happen that traders recall this fact after the Nonfarm Payrolls report is published. If so, the pound-dollar pair is likely to recoup some of its early losses and return to the opening level of 1.3500. How is trading going to unfold in the short term? We will definitely tell you in our next video reviews. Don't miss them and stay up to date with the latest market news. See you!